And so what I wanted to share today was like the top 10 questions that we get on a daily basis. And this will be a video that you could share with your clients. You could share with any of your friends or family, anybody that might be looking to purchase a home in the near future. We're going to be talking, just breaking down some of the basics of buying a property and going through the process and all of that. And we will be opening it up for live questions. So if you put in your questions in the comment box, we'll be sure to answer those. Also, like the page and share the feed if you enjoy the content. So let's get right into it. So what is the big advantage of buying a home versus renting anyway? I think about that myself. I think about all the past clients that we've served. And one of the greatest things about buying a home is the creation of wealth. When you rent, that payment goes straight to the landlord every single month. After 5-10 years, there's really nothing to show for it. When you buy, you're creating an asset. So you're creating a home that's going to go up in value. The loan balance will go down over time, and you're going to create this equity. So what does that look like? What I want to do is break it down. So anytime I'm meeting with first-time home buyers, I go through like a rent versus own analysis, and I really break this down for them so they can see the true advantage of buying versus renting. So I ran some numbers based on a $300,000 house. So we got a $300,000 house. I picked one out that was here in Palm Beach Gardens. And over here, we got your rent. And over here, we'll say we're going to buy. So this particular house rents for about $2,100 a month. To buy this home with 5% down, the payment would be about $1,449 plus taxes, insurance, about $663, and maintenance about $125. So total payment was about $2,237. So just from the looks of it, you can say, wow, it's actually cheaper to rent this house than it is to buy it. Well, what do we know about rent? We know that rent typically goes up every year. So rent typically goes up at about 3% per year. So over time, this payment will actually exceed this payment. If we take this scenario out over 7 years, in 7 years, the rent will be about $2,500 on this rental here, which would actually be more than what you would your payment. So one of the biggest advantages of buying a home is that when you buy, your payment stays the same. This number here, your principal and interest, doesn't change. It's fixed for 30 years. Now your taxes and insurance, those could be variable, but the great thing about when you homestead a property in Florida is that your taxes, these are going to be capped at 3% per year. So you're not going to have huge fluctuations. Your insurance could go up or down depending on insurance values. And HOAs, of course, could go up and down a little bit. But overall, your payment's going to stay relatively stable for 30 years. Rent, we never know what's going to happen. I've had some clients call me and say, hey, listen, my rent went up 10%. So these are things to think about. This is a big advantage of buying versus renting. Another big advantage of buying versus renting is just the value of having a home and being able to do anything you want with that home. So if you want to paint the interior of your house pink with white polka dots, you certainly can. Maybe your landlord wouldn't want you to do that, but you can modify your home. You can do anything you want to your home. It's your home. So let's take this out over 7 years. We're going to take this out over 7 years, and let's just take a look at this to see if I bought the home, what would my true equity be, and if I rented, what would I spend? So if we take this out over 7 years, when you buy a home, one of the great things that happens is you get the advantage of having appreciation. So homes typically appreciate at about 4% per year. That's also the forecasted appreciation right now for Palm Beach County. That means that the home value is going to go up about 4% per year. Lately, it's been going up a lot higher than that, but we'll just use that as a number. So we got 4% a year appreciation. Just going to abbreviate that. So over 7 years, if you were to buy this home for $300,000, you would have $93,000 in appreciation. So you bought it for $300,000, it's now worth $393,000. It's a beautiful thing. Now the other thing that happens is that the loan, when you make that monthly payment, a portion of this pays your principal down every single month. So over 7 years, your loan would amortize by about $32,000. So your loan is going to go down by about $32,000. So let's just say you sold the home. So you decided not to rent, you decided to buy, and in 7 years from now, you wanted to sell the house and move somewhere else. Maybe you need something a little bit bigger. Maybe you wanted to move to a different area. Well, when you sell a house, you also have closing costs. So typically you're paying a realtor 6%. You also have to pay doc stamps and some other costs. So cost to sell, let's just estimate $27,000 to sell the home after 7 years. So once we do all the math, at the end of 7 years, you sell this home and you put $95,000 in your pocket. That's the equity. That's wealth. That's how you create wealth. So ask yourself this question. In 7 years, can you save $95,000 in a savings account? A lot of people can't. It's hard. It's hard to save that type of money. So this is like a forced savings account. It's a really, really beautiful thing. I talked to some clients right now. We're talking to a lot of past clients because we're refinancing their loans to get them lower rates because rates went down. And some of these people bought homes for $200,000 or $250,000 a couple years ago, and these homes are worth like $350,000. They've gone up in value by huge amounts, especially if they bought it at a great deal and fixed it up. So this is how you create wealth. Home ownership, appreciation of the asset, amortization of the loan, and your wealth. So one of the stories that I always tell is that my first house I bought for $137,000. My payment was around $1,200 at the time, and I was sweating it. I didn't think I was going to be able to make the payment. I think I was renting for around like $1,000 a month at that time. So I rented out one of the rooms to a friend of mine to mitigate some of the costs. I rented out one room for $500, and then I ran out the couch for a little while, and then I fixed the house up over the course of the next couple of years. 2 years later, that house was appraised for about $185,000. Now, I fixed it up, but it wasn't like anything significant. I mean, I painted it, I fixed the landscaping, things like that. It wasn't anything major. But the great thing about that was at a time where I was getting ready to start a mortgage company. And what I did is I was able to pull an equity line out of that house for about $35,000 and use that to start my mortgage company at the time. So I only tell that story to explain the value of this exercise here and the value of creating this equity, because if you don't sell it, you still have this equity. So you can tap into this. So you could do a home equity line of credit, you could do a cash out refinance, you could access this equity and use it to do different things. For me, it was starting a business. For me at the time, I wouldn't be able to save $35,000. I had like nothing in the bank, but I knew what I wanted to do. If I wouldn't have bought this house that I bought, I would have never been able to get the equity. I would have never been able to start the mortgage company, and I probably wouldn't be here right now talking to you. So I just tell that story because I think it's powerful, and this is the reason why homeownership is such a great thing. All right, another question that we get a lot is, what type of credit do I need to get a mortgage? So a lot of people think, oh, I need a 700 credit score, or I need some super high credit, and that's just not the case. So with an FHA loan, you can buy with as low as a 580 credit score, With a VA loan, if you're a veteran and you've served in our armed forces, $580 as well. With the conventional loans, they're a little bit higher, they're $620. But as you can see, you don't really need super high credit to get a loan. How do I increase my credit score? That's another question. So you don't necessarily have to have a high credit score to get a loan, but the score does determine your interest rate. So if you are a 620 versus a 720, your rate could be 0.5% different. So of course it makes a lot of sense to have the highest credit score possible, because that's going to get you the best terms on the loan. How do I increase my credit score? So if we look at your credit score in a big graph, sorry, my handwriting's terrible. So if you look at your credit score and we put it in a big graph, one of the biggest parts is pay history. So that's how you pay your bills. Are you late on your credit cards? Are you late on your rent? Are you late on your car payment? That type of thing. This is heavily weighted over the last 12 months, your pay history. And this is about 35%. About 30% is what you owe. So this is how much you owe on your, say, your credit cards. Primarily, the weight of this credit score is on your, how much you owe on your revolving credit cards. So if you have a credit card for $5,000 and you owe $4,900, then that's going to tank your score. And one of the things we do with clients sometimes is we get the credit report, and if we look at it, if we see a lot of high balances to your credit limit, we have a tool where we can do an analyzer through the credit bureau, and we can say, okay, if you owe $4,900 on this card with a $5,000 limit, if you paid it down to $2,500 or 50%, what does it do to your score? So we do a lot of these dynamic scorings every day as a matter of practice, and so we can kind of see it. So what I can tell you is that if your balances are 50% or lower, your score is going to go up. If you're maxed out or over the limit, your score is going to tank. The sweet spot is you want to be about 30% of your credit limit. That's where you want to be. So if you're going to be applying for a mortgage in the future, or any type of credit really, what I would do is try to keep your balances at about 30%. Now, if you have small limits, you might want to either ask for an increase for your limit, so your balance is lower, or what you can do is maybe make payments on your credit cards a few times per month if you're really active with your credit cards. That way it keeps the balance lower, or maybe just use your debit card. So 30% is amount owed. We got 15% would be length. So that'd be length of your credit history. So let's just say you haven't had any credit and you just started opening credit cards and credit accounts this year, then this would play into a factor in your overall score. 10% we have credit inquiries. So this is how many times you've actually applied for credit. So, you know, one of the big misconceptions that there is that you can't say apply or get pre-approved by multiple mortgage companies at the same time. It's going to tank your credit score. That's not the case. You can apply as many times as you want within a 30-day time frame in the same industry, and it only affects your score once. So a lot of clients ask us, okay, well, how many points does a credit inquiry deduct on my credit score? And the answer is, you know, it's all relative. There's not just a single number. If you're an 800 credit score, we've seen inquiries not take anything off. If you're a 600 credit score with high balances on your credit cards, an inquiry could whack you 20 points. So it all depends. You know, it's an algorithm that the credit reporting companies use, but if you think of it logically, if you have a lot of balances on your credit and your high balances and you're inquiring, that means you're probably trying to get more credit that you might not be in a good financial standing, so that's going to score you lower. So if you think of it like that, if you barely use credit and barely apply, it's probably not even going to affect your credit report at all. And this is a terrible graph, sorry everybody, but this is 10% as well. And this is types of credit. So do you have like a diversified credit portfolio on your credit report? Do you have installment loans, credit cards, a mortgage? Is this diversified? Or do you just have revolving accounts? Or do you just have installment accounts? So it's important to have multiple types of credit. So this overall, but what I can tell you is like what we see the most is really like these two sections. How much you owe, keeping your balances low, and then the pay history. Pay history, like if you've had any late payments, recent, it's going to tank your score. Any collections, recent, it's going to tank your score. Bankruptcies, foreclosures, all of this stuff would fall into this bucket. So these are really the heavy weighted areas right here. So staying on the credit subject, one of the questions we get a lot is Credit Karma a good place to check my credit score? So the answer is not really. So Credit Karma is a for-profit business. They give you a free credit score in exchange to monitor all of your credit data. So they basically look at your spending habits and then they'll create offers to try to sell you products. So credit cards, car loans, things of that nature. So let's just say your car loan, they can tell on your credit report, maybe you're almost done paying off your car. Well, all of a sudden you start getting offers for new car loans because you might be looking to apply again. Same with credit cards. So keep in mind they are a for-profit business. The credit scores that they give you is called a Vantage score. This is not the same score that we use in the mortgage industry and that most other creditors do not use it. It's a score that is similar, but it's not accurate. So I have a lot of clients that come in and they say, oh wow, my credit score is an 800. Look, here's on Credit Karma, I'm 800. And we pull it, it's a 700. Or they pull it, it's a 720, and we pull it, it's a 650. And they get really upset. So what I always say about Credit Karma, it's a great place just to monitor your credit so you can kind of keep an eye on any inquiries, or maybe if somebody opened up accounts in your name that are not yours, or just to monitor your balances and just the overall health of your credit report. But don't look too hard into that credit score because it's never, it's very rarely the same as what we pull. Very rarely. It always pulls higher. So just beware on Credit Karma. But use it as a tool. It's a great tool to use. Another question I get a lot is how much down payment do I need? So if you're a first-time home buyer, you can buy with as little as 3% down on a conventional loan. With an FHA loan, it's 3.5%, and on a VA loan, it's 0%. So you can buy with very little out of your own pocket, and it's really not that much. If you think about, if we go back to that same example of a $300,000 house, 3% would be $9,000. So this is what you would have to save for a down payment. Now this down payment here, it does have to come from either you, it can come from a gift, it also could come from if you have a 401k or an IRA, you can access money from there, typically tax and fee free right now because of the government passing through the CARES Act. Or you can borrow for a 401k and pay it back. Also, we'll talk about a little bit later some programs that maybe some local nonprofit programs that can actually help you with some of this down payment as well. So there are a lot of low down payment options out there. Another question we get is, what's the big deal about putting 20% down? One of the biggest misconceptions. People say, do I need 20% down to buy a house? That's what I hear. I have to put 20% down. The answer is no. You do not have to put 20% down. So what's the difference? Why do people always say 20% is like the magic number? So 20% on 300K would be $60,000. That's a big number. A lot of people don't have $60,000 just laying around. So the biggest difference between these two programs is that this is 3%. Obviously, this is 20%. This loan will have what's called PMI. Private mortgage insurance. So what is this? What is private mortgage insurance? So private mortgage insurance is basically an insurance policy that you have to have if you don't put 20% down on your loan. So there's about 6 private insurance mortgage companies out there. If you're doing less than 20% down, we would basically shop all of them to try to get the best premium. But it's like a risk-based insurance policy. And if you end up going into foreclosure, this private mortgage insurance would kick in and it actually would cover a portion of the loss that the investor would have. So if this loan was sold to Fannie Mae, which is the government entity that buys loans, and you defaulted, the private mortgage insurance would come in and protect or kind of make whole some of the loss that Fannie Mae would have had on that loan. So that's why it's required. With 20% down, you don't have to have mortgage insurance. There's no PMI. So how much is PMI? So PMI, it's all based on risk. So if you're an 800 credit score with very low debt to income ratio, then your mortgage insurance would be very low. If you have very low credit scores and high debt to income ratios and other risk factors, the premium could be very high. So it's all dependent on the risk from your personal profile. So like on a $300,000 loan, maybe just as an example, if you're well qualified, mortgage insurance could be around, let's just say $200 a month. It could be lower, could be higher, depending on the program and the situation. Now, the great thing about private mortgage insurance on conventional loans is that over time, this can go away. So after 2 years, when you have 25% equity, you can request cancellation of the mortgage insurance. So after 2 years, the 25% equity could be through amortization, what we talked about before, so the paying down of that loan, and through the appreciation of the home going up in value. After 5 years, it drops to 20%. So with a conventional loan, you can remove this mortgage insurance over time. That's why conventional is always the best loan if you're a well-qualified individual. Good credit, lower debt-to-income ratios. So that's the big thing between the whole 20% down question that we get and low down payment options. Now, I'll just show you one other option, which is the FHA. A lot of first-time home buyers use the FHA. FHA allows for a 3.5% down. Their mortgage insurance is not risk-based. Their mortgage insurance is a set fee. So whether you have an 800 credit score or a 580 credit score, the mortgage insurance is always the same. It's 0.85% times your loan amount divided by 12. Now, this mortgage insurance is not cancelable. So the downside with the FHA is that you can never get rid of the mortgage insurance. So after 10 years, if you have 50% equity in the property, the mortgage insurance is still there. So with an FHA, what we would do is over time, we would refinance you and put you into a conventional loan. We're doing a lot of that right now. A lot of our FHA borrowers we put into loans 2 years ago, or even a year ago, we're refinancing and putting them into conventional loans. But the FHA allows for the most leniency on credit score, debt-to-income ratio, and it doesn't penalize you for having a lower credit score with rate or mortgage insurance. All right, another question we get all the time. What are closing costs? How much should I expect them to be? So closing costs. So closing costs is kind of a vague term. If we talk specifically closing costs, those are costs of buying the home and getting the mortgage. So you have two things. You have closing costs, and then you have prepaid items. And they both fall under the bucket settlement costs. So a lot of people get very confused because they think closing costs are settlement costs. So settlement costs are anything that you have to come out of pocket when you're buying a home. So you have actual costs of purchasing it, and then you have items that you have to prepay in advance. These are not to get confused with cost. The best way to think about the difference between cost and prepaid items is that if you were to buy the home and then sell it a week later, the closing costs you would not get back. Those are costs. The prepaid items you would get refunded to you because those are items that you're advancing for the future. So what do I mean here? So closing costs could be origination charges, your appraisal, your survey, that would show your property lines, your boundaries, government charges, that's intangible tax, doc stamps on the mortgage, recording of the mortgage at the courthouse. These are all the taxes that we have. In Florida, we don't have a state income tax, but we have pretty high real estate taxes. You also have title fees. In Palm Beach County, it's typical the seller pays the title insurance. In other counties like Broward and Martin, a lot of times the buyer pays it. A lot of people ask me like, so what is title insurance? What are these like title fees? So the title company is typically the one that will close your transaction. They're the one you would go to their office, you would sign all the documents. They kind of bring all the paperwork together. They make sure everything, all the charges are in one sheet in the closing disclosure. And they also issue the title insurance policy. So the reason we have title insurance is that it's just that. It protects the title of your home. So when you purchase this home, you want to make sure that there's no liens on that property. You want to make sure there's no defects to the title. You want to make sure that the power bill was paid and the water or any liens. Maybe a contractor that was doing work on the house wasn't paid. You want to make sure all of that's taken care of when you purchase the house. You also want to make sure that the person selling you the house actually has the rights to sell you that house. So that's one of the beautiful things about this title insurance, that it protects you. Nobody can come to you down the road and say, hey, listen, that seller sold it to you, but they didn't have the right to sell it. The title insurance would kick in. So this protects you, and it protects us as the lender. So you have all these different types of fees. I always estimate, if you're buying, say, a $250,000 house, your closing costs, you're probably going to be around $5,000, just as kind of a rough number. Whether the house was, say, $200,000 or $300,000, this would maybe go up by a few dollars because a lot of this stuff is fixed. There's only a few variable costs. Now, prepaid items, what are these? Now, these can vary greatly depending on the house that you choose. So these are insurance, so your homeowner's insurance. So if you're buying, say, a $300,000 house that's in Lake Worth that was built in the 1940s, that's close to the water, this insurance could be very high. You could be paying $5,000 a year for it. If you're maybe in a newer house, west of 95 with brand new roof and all the hurricane shutters and that type of thing, maybe the insurance is $1,500 a year. So insurance, you got to pay for 1 year. So whatever that policy ends up being. So let's just say $3,000 for now, just as an example. Other prepaid items, we have to set up your escrow account. So your mortgage payment that you make every month will include your principal and interest, and then one portion or 1/12 of tax, 1/12 of insurance. So when you make that payment every month, it includes your tax insurance. When the bill comes out, we pay it in full for you. So in order to set that up, we have to set up an escrow account. So for insurance, we'll get 2 extra months of insurance payments. So in this case, it's $250 a month. And then for tax, this will be prorated, but I always estimate about 6 months for tax. So let's just say your taxes are $6,000 a year. That's $500 a month. So we collect about $3,000 for a tax escrow. And then you also have any prepaid interest. So we'll just assume for now we're going to close on the 1st of the month. There'll be no prepaid interest. If you close, say, on the 30th, we'd have to collect 1 day of prepaid interest. We prorate out the interest. But in this example, let's just use this. So your total prepaid items would be $3,000 plus $3,000 plus $500. So you're looking at about $6,500 in prepaid items. So sometimes clients will say, oh my gosh, I didn't realize closing cost was $11,500. And the answer is it's not. Your closing costs were $5,000. Your prepaid items were $6,500. Again, if the insurance was super high or your taxes were super high, this could be higher, and vice versa, it could be lower. So it's important to understand the difference of these 2 items and to make a clear separation in your mind. Now, if we went back to that previous example about $300,000 with 3% down, that's $9,000. So your down payment in this case would be $9,000. So that was your $9,000 down payment. And then to that we have to add $5,000 and then $6,500. So now we're talking a little over $20,000 out of pocket to buy the house. So some people say, wow, that's like way too much. I wasn't expecting $20,000. I was expecting $9,000 or maybe a little bit for closing costs, but they weren't thinking about prepaid items. So in this case is when we negotiate that contract, we'll work with your agent. And I know a lot of the agents I work with are just amazing negotiators. So what we can do is we can request the seller to pay for some or all of this down here. And this is just a matter of negotiation. So if the property sells for $300,000 and maybe it's listed for $300,000, so instead of offering them $290,000, maybe you offer them full price. You offer them $300,000, but you say, listen, seller, I want you to pay $10,000 of my closing costs and prepaids. So that way you're just coming up with your down payment. Seller's paying $10,000 of this, so maybe you're like $10,000 out of pocket. So that's what we have to do. We have to think outside the box sometimes when looking at cash to close. So this is what we do with your realtor. Another question we get is we hear there's a difference between fixed rate and adjustable rate mortgages. I mean, right now, fixed rate mortgages are really the best option. There are some other products out there that are adjustable rate. This means where your rate is not fixed over the full 15 or 30 years. What I would say if you're a first-time home buyer, it probably makes the most sense to be in a fixed rate. That way, nothing changes. The payment's the same every single month for 30 years. Adjustable rates, those are typically fixed for a short period of time, 3, 5, 7, or 10 years. And then after that, they adjust based on the market. Well, nobody has the crystal ball, so it's a lot of risk to not know what your rate's going to be in the future. So our suggestion is always a fixed rate mortgage, unless you're maybe in the high net worth or jumbo category where adjustable rates are better, or maybe you know it's going to be a short horizon that you'll have this loan and either pay it off or sell the house. But I would say for the majority of people, fixed rate's the best option. Another question we get is, I hear about locking my interest rate. What does that mean? So locking a rate is once you're under contract, we can lock in your rate so there's no market fluctuations from the time that you are under contract till the time that you close. So let's just say you sign a contract with a seller today and we're closing at the end of the month. What we would want to do is we'd look at the market and we would lock in your rate. That way there's no fluctuations. The last thing we want to say is, hey borrower, your rate's 3.5% today, and then a couple weeks later, oh, rates went up to 4%. Now your payment's going to be $50 higher per month. So it's very important that we get a contract in that we lock you and protect you all the way through closing. One other question that we get a lot is what type of mortgages are available and what's the big difference between the mortgages. We already touched on it before, but primarily there's three types: FHA, VA, conventional, and I'll throw in jumbo as well. So the advantage of the FHA is it's 3.5% down. Now in Palm Beach County, the maximum FHA loan, it's around $373,000. VA, if you're a veteran with eligibility, it's 0% down. Now with the VA loan, I would just point out that it's 0% on the loan, but you still have those closing costs and prepaids that we talked about before. So that's a negotiated item. Just because you have the VA doesn't mean that closing costs and prepaids are free. We have to negotiate the seller to pay those if you cannot. VA loans, there's actually no limit on these anymore. So if you want $1 million VA loan, you can certainly have that as long as you qualify. Conventional loans, as a first-time home buyer, you can do as little as 3% down. If you're not a first-time home buyer and you're buying a primary residence, it's 5%. If you're buying a second home, you would be going with a conventional loan. Minimum down is 10%. And if you're buying an investment property, you would also go with a conventional loan. Minimum down on investment property is 15%. Unless it's a multi-unit property, if it's a multi-unit investment, we're looking at 25%. 2 to 4 units. So FHA is your primary residence, low down payment. VA, 0% down, veterans, no limit. Conventional, we have lots of options under the conventional category. Maximum loan on this is $510,400. And then basically the jumbo category over here, this is any loan that exceeds $510,000. Jumbo loans typically are 20% down. You have to be well qualified with jumbo loans. So those are the four primary categories of mortgage loans. And that's what I had on my top 10 list. I know Adrian got a few questions on the air. So what questions do we got, Adrian?
So we actually have some questions here. And one of the ones that I want to read says, what is the process for qualifying for a loan? So what is the process for qualifying for a loan?
So that's a good question. So the process for qualifying, the very first step is we have to get a basic application. So we have to get some basic information from you. Here with my team, we typically take that information over the phone. But if you have a really tight schedule, we can send you a link to do like a digital mortgage online where you can enter in the data. But typically it's a 5 to 10 minute conversation where we ask you questions about your credit, your income, your employment, housing history, assets, things of that nature. So that would be the very first step. Once we get that information, we'll request some documents from you, items that you would kind of figure that we would need. So your pay stubs for the last month, your W-2s for the last 2 years, your asset statements, your bank statement, for the last month or two, any 401k or other assets statements that you have. If you own other properties, we'll need the data on those, your tax, insurance, mortgage statement. So we'll request those documents from you, and then we schedule your loan consultation. So loan consultation, right now we're typically doing them over the phone or Zoom, Zoom conference. And we also love doing our in-person consultations. Pre-COVID, we were doing about 70% of our applications in person, our loan consultations. So in the loan consultation, whether it's in person on the phone or over Zoom, what we're going to do is we're going to go over your monthly payment, your cash to close, the different options here, advantages of each, what you qualify for, and answer any questions that you have. Once you do your loan consultation, at that point we have all your docs that we've validated and verified, and then we'll issue the pre-approval letter so you can go out shopping for a home.
So actually, now that you mentioned pre-approval, one of our other questions is, what's the difference between being pre-qualified and being pre-approved?
Great question. So there is a huge difference between being pre-qualified and being pre-approved. So a pre-qualification is basically when you talk to a mortgage lender, you give them some basic information, they run your credit, and from what you've told them over the phone, you are pre-qualified to purchase a home up to a certain amount. Now, without verifying and validating your documentation, usually pre-qualification letters are garbage. Usually they're not worth the paper they're written on, because you have to validate and verify the information. You know, if somebody says, oh, I make $100,000 a year, until we get the W-2s and the pay stubs, you know, we don't really know if they make that much, or we can actually use that income to qualify them. I had a client the other day who makes quite a bit of money from what he told us over the phone. But the thing is, he just started at this employer, so half of his income is through bonus. Well, in order to use bonus income to qualify for a loan, you have to be receiving it for 2 years. So we had to take out almost half of his income for qualification purposes. Just little things like that. So it's so important that we validate and verify the information. A pre-approval letter is basically that. It's your application, we run your credit, we've validated and verified all your information, pay stubs, W-2s, tax statements, verification of employment to make sure you're not furloughed or laid off or you're still working, and that all the information matches. From there, we issue the pre-approval letter. That's how we do our process. Now, different companies do their process different ways. So if you're a real estate agent watching today and you get a pre-approval letter from a lender that you do not know, it's so important to call them and ask them about their process. The letter might say pre-approved, but you want to ask them, have you run the credit? Do you have the income and asset statements? Do you have the tax returns? You know, it's so important to ask those questions. But that's the big difference. For our pre-approval, when we send those out, we know that they're going to close. We don't issue a pre-approval and they just do not fall out. We validate all the information before sending them. Great question.
One of the last questions we have on here is it a good time to refinance right now?
It's a great time to refinance. So, you know, rates are at historic lows, some of the lowest we've ever seen in the history of mortgage rates. So there's a lot of advantages to refinancing. If you do have a current loan and you're going to be staying in that house for at least the next 2 years, I would certainly take a look at refinancing that loan. A lot of our clients save anywhere from $200 to $500 per month just in a rate reduction. There's other advantages you can do as well, some kind of tricky things you can do with your loan as far as debt consolidation, or maybe doing home improvements. Or a lot of our clients right now are switching from 30-year loans to 15-year loans. So maybe they've been in the loan for 5 years, so they have 25 years left, but we're switching them into a 15-year loan, dropping the rate way down, payments staying about the same, but they're literally shaving 10 years off their loan. So there's a lot of advantages to refinance right now.
So next question is, how much home can I afford?
So that's kind of a tricky question. So it's all going to be dependent on your income and your assets and your credit profile, but primarily your income. So the way we look at it is we take about 45% of your income maximum can go towards your housing payment. That's like the max. And we calculate everything off of a gross income. So just as an example, if you make 10 grand a month, your mortgage payment can't exceed $4,500. Now, obviously that's a pretty big example, but those are the things that we'd have to look at. It's very important. I mean, if you just kind of think about it in round numbers, let's just say you make 3 grand a month, just 50% of that's $1,500. So you're going to want to probably be in like the $1,400 range for payment if you make 3 grand a month. If you make 5 grand a month, you know, maybe you could be like in the low 2000s for total payment. That's tax, insurance, and everything. So what I would suggest is submit your application, let us run the numbers for you, and we can tell you exactly what you could qualify for.
Awesome. Next question is, can I buy a house if I was furloughed due to COVID?
So the answer is if you are furloughed and you have a return date. So right now there's a lot of clients that we either have in process or that we've been talking to with pre-approval that have a return date. So some clients that work in hospitality, they were furloughed, meaning they were sent home without pay, but now they're starting to get a return date. So the employer might be saying, okay guys, we're coming back to work on June 1st. If you have a return date, we can still close your transaction. If you've been working there and then you have reserves in the bank, we can still do that. So yeah, so the answer is yes. If there's no return date, the answer would be no. We'd have to wait until there's a return date.
And last question is, are there any options to assist us with down payment?
So there are other options to assist with down payment. As I mentioned before, there are some local nonprofits that we've partnered with that provide a down payment assistance program. So if you meet certain qualifications, sometimes we can get you a grant for around $5,000 to assist with your down payment on a conventional loan. So for that, again, the first step would be is you'd have to submit your application, we'd get some basics from you, and we'd see if you could qualify for it. Now, the guidelines on those programs are a little bit more conservative, but if you can meet them, it's a great way to get a grant. The way these grants work is that they would give you $5,000 to assist with your down payment. If you stay in the property for at least 5 years, that $5,000 is then forgiven. You do not have to pay it back. So that's called a down payment assistance program. So yeah, there's still some of those out there, and those are great programs for certain clients. Cool, and I think that's it for the last of the questions. I just want to thank everybody for joining us today. Again, if you saw this information was useful, please forward and share it to any clients that you have, any friends or family that might be looking to purchase in the future. If you have any questions at all, feel free to call us at the office, send us an email. We'd love to have a conversation with you to see how we might be able to serve you and help you get into your home. With that, we just wanted to thank you again for watching today. Wishing you guys all the best and be safe. Talk soon. Bye-bye.